Bitcoin looks like it is trying to break free again. The chart is moving, the headlines are getting louder, and every bounce makes the same question come back. Is this the beginning of the next major Bitcoin move, or are bulls walking into another liquidity trap? That sounds dramatic, but the point is not drama. The point is structure. Bitcoin does not move in isolation. It is not only fighting a chart level, it is fighting inflation, Treasury yields, the Federal Reserve, ETF demand, and capital rotation. And when those liquidity gates are not aligned, Bitcoin can look strong on the surface while still being trapped underneath. The first gate is inflation. The latest CPI report showed headline inflation running at 4.2% over the last 12 months, with energy and gasoline doing a lot of the damage. Core inflation was calmer, but not low enough to make the problem disappear. That is the uncomfortable setup. If inflation is still too high, the market cannot simply assume that easier money is coming quickly. And Bitcoin, like other risk assets, usually performs best when liquidity is expanding, confidence is rising, and investors believe the cost of money is moving lower. This is why a Bitcoin bounce can be real in the short term, but still incomplete in the bigger picture. A bounce tells us buyers are defending a zone. It does not automatically tell us that macro liquidity has turned. The difference matters. A technical bounce is price action. A liquidity shift is fuel. Without fuel, the move can stall, reverse, or become a trap for late buyers who enter after the first green candle. The second gate is Treasury yields. The 10-year yield is still sitting around a level that keeps pressure on risk assets. When yields stay high, investors have alternatives. They can hold cash, buy bonds, or wait for clearer conditions instead of chasing volatility. That does not mean Bitcoin cannot rise. It means Bitcoin has to work harder. Every rally has to compete against a market where the risk-free return is still meaningful and where long-term rates are not giving a clean green light. This is the part many traders ignore. They look at Bitcoin and ask, is the chart bullish? But the bigger question is the liquidity environment bullish enough to support the chart? If yields are high, inflation is sticky, and the Fed is not ready to ease, Bitcoin can remain stuck even when the chart looks ready. The market doesn't need a reason to reject a breakout. It only needs the absence of enough liquidity to confirm it. The third gate is the Federal Reserve. The next FOMC meeting matters because the market is not only looking at what inflation did last month, it is looking at how the Fed interprets it. If the Fed sounds patient, cautious, or uncomfortable with inflation, then the market has to reprice the timing of easier policy. And if rate cuts move further away, the liquidity story becomes weaker. Bitcoin does not need the Fed to cut tomorrow, but it does need the market to believe that the next major direction is toward easier conditions, not tighter ones. This is why the word trap is useful. A trap is not the same as saying Bitcoin must collapse. A trap means price can move first, while confirmation arrives later. Bulls see the bounce. Bears see the macro pressure. The disciplined investor waits for the gates to align. Inflation must stop threatening the Fed. Yields must stop pushing capital back into safety. ETF flows must stop bleeding, and the Fed must stop sounding like liquidity is still on hold. The fourth gate is ETF demand. This is one of the cleanest signals because it shows whether institutional demand is supporting the move or stepping away from it. When Bitcoin ETF flows are negative, the market loses one of its most important support engines. ETF demand does not control every candle, but it changes the quality of a rally. A rally with strong ETF inflows feels different from a rally where flows are weak or negative. One has sponsorship, the other has suspicion. That is the key distinction for Bitcoin right now. The question is not whether Bitcoin can bounce. It already can. The question is whether the bounce has enough sponsorship to become a trend. If ETF flows are still leaking, if yields are still high, and if inflation keeps the Fed cautious, then Bitcoin can remain trapped between hope and confirmation. There is also another pressure point: capital rotation. Money is not sitting still. It is constantly choosing where the strongest story is. Sometimes that story is Bitcoin. Sometimes it is AI. Sometimes it is semiconductors. Sometimes it is cash and bonds. Right now, Bitcoin is not only competing against fear, it is competing against every other place where capital believes momentum, safety, or yield may be better. That is why a Bitcoin rally can look exciting but still fail to become dominant. So the calm way to read this market is simple. Bitcoin bulls are not wrong to watch for a breakout, but they are early if they ignore liquidity. A clean bullish case needs more than a green candle. It needs CPI to cool, yields to ease, the Fed to sound less restrictive, ETF demand to return, and capital rotation to stop favoring other trades. Until those pieces improve together, Bitcoin may not be free. It may only be testing the walls of the trap. This does not mean panic. It means discipline. If Bitcoin holds key zones while macro pressure starts to fade, that would be constructive. If ETF flows turn positive again and yields begin to move lower, the bullish case becomes stronger. But if price rises while liquidity remains weak, then the move deserves caution, not celebration. The market is giving us a very clear lesson. Price gets attention, but liquidity decides durability. Bitcoin can move fast, but without macro confirmation, fast moves can become dangerous. The real question is not whether Bitcoin can bounce. The real question is whether the liquidity gates are finally opening, or whether bulls are stepping into another trap. This is the calm metrics. No hype, no panic, just the signal behind the noise. This is the ALM metrics. No hype, no panic, just the signal behind the noise.